Yes, I hope you people have gone through this question scenario. So let us start solving it. So the question name is, yes, here we are. Fernhurst Company. Question 37 from Kit. Now, financial acceptability of the project. Fernhurst Company is a manufacturer of mobile communication technology. It is about to launch a new communication device, the Milan, which its directors believe in both are technology, technologically advanced and easier to use than devices currently offered by its rivals. Investment in Milan. The Milan will require a major investment in facilities. Fernhurst company's directors believe that this can take place very quickly and production will start almost immediately. Now, Fernhurst company expects to sell 132,500 units of the Milan in its first year. Sales volume is expected to be increased by 20% year 2, 30% year 3, and then be same in year 4 as well as year 3. And the product reaches the end of its life. The initial selling price in year 1 is expected to be 100 before increasing the rate of inflation annually. The variable cost is expected 43.6 in year 1, raising by rate of inflation. I'm sorry. Fixed costs are expected to be 900,000 in 1, rising by rate of inflation subsequent year annually. Investment is this. Fernhurst company need to investment of this in working capital. The working capital will increase at the start of year 2 by inflation rate and is fully recoverable at the end of product's life. First will be incur one-off marketing expenditure post-inflation after the launch of the Milan. At the end of year 1, be tax allowable. They pay tax on profit at annual rate of 25% in the same year. Tax allowable deficit is 20% investment in non-credit base, reducing balance basis. A balancing adjustment will be available in year 4. The residual value expected at the end of year 4 is 0. Inflation rate is 4% in year 1 and 5% in year 2 to 4. Investment appraisal cost of capital is 11%. Wonderful question. Very easy, straightforward question it is. What we have to do? We need to start with the working. So first of all, inflation rates, year 1, 2, 3, and 4. Because inflation rates are being utilized everywhere. Inflation rates in the economy. What is that they said here? Inflation is 4%. Yes, working capital. Here was inflation. Just a minute, I missed it. Where it has gone? Yes, here it, sorry. Here it is at the end. 4% here. and 5% in year 2 to 4. Inflation. Now the working one, sales. We need to do that. Starting with units. Units sold in year 1 is 132,500. Expected to increase by 20% in year 2. This into 1.2. Then 30% in year 3 and 4. In 3. This into 1.3. No, you are not seeing my Excel? Are you sure? My Excel sheet is not visible to you?
I can see only the Fernhurst Co question 37. I can't see what you're typing, like the inflation and all.
How many of you can't see my Excel sheet? Tell me. Only one person is saying, or what about others? Can you see my Excel sheet? So you just once it should be visible now. If it is visible to others, it should be visible to you as well, dear. It should be visible to you as well. You can see what I'm typing in the student is saying what I am typing, that is not visible in Excel. Tell me now, is that visible what I'm typing in Excel? The sales unit I have mentioned, is that visible to everyone? Yes, please. Others, advise, please. Good. Thank you, Muzammal. So now it should be visible as well, dear. So should I proceed now? Just check your site. It is on your side. The issue is on your site. Okay? Now, then they say 30% year 3 and increase. Yeah, it is same in year 4. This into 1.3, 30%. In the first year, This second year 20% and then 30% in year 3 and 4. Now, next point. The next point is selling price. Inflated. This is selling price in the first year, it will be 100 per unit in the year 1. In the year 1, it will be 100. And then selling price per unit. 100. And then increasing with the rate of inflation. This into 1 plus inflation rate. Here it is. Next, sales. We can easily calculate now. Selling price into number of units. Selling price into units. Now, so sales is here. Next is variable cost. Working to per unit. First of all, per unit, they say it is 43.68 in year 1. And then increasing by inflation. This into 1 plus this inflation. So total variable cost. This into number of units. Wherever you are confused in a calculation, don't hesitate to ask me. Ask me immediately. Next, fixed cost, working 3, fixed cost. So fixed cost, they say in year 1, it is 900,000. And then inflation, this into 1 plus fixed cost is here in front of you. Next, anything else remaining? Nothing. So come here, we have to do another working. That is working capital. So working capital, they say immediately. And then at the start of year 2 to 4, by rate of inflation in those years. Yes. So initially, if I say year 0, at start of project, it will be 1025 outflow. Okay. The next, they say rate of inflation. This at the start of year means in the previous year. 1 plus this. Start of year 2, start of year 3, start of year 4. And this amount is total working capital required at the start of each year. Incremental working capital. Incremental now. So initial outflow will be this. Then this minus this. This is additional outflow. Totally outflow required, total working capital required is 1066. They already have this. So difference will be the outflow. Now they need this. Already have this. Same is the case here. And this whole amount will be recovered at the end of the project. They say it is recoverable at the end of the project. Even they had not, if the question was silent, were silent about it, we would have assumed the same recovery of the invest working capital at end of the project. We would have considered the same. Next. The next is working 5. That is capital allowance. initial investment is 16 million. And it is 20% on reducing balance basis. Realizable value 0, 16 million. So WDV, return down value 16 million. Capital allowance 20%. Of this, written down value, this minus this. This into 20%. This minus this. This into 20%. This minus this. And the whole will be charged here. Capital allowance. Simple calculation, 20%. Now the whole working is done, almost. We are near to complete the question now. Let us proceed and make, yes, the question here. Now, so first of all, sales. Linking the cell. Less variable cost. Minus here we go. Less fixed cost. Minus fixed cost. Less marketing cost. Never forget such one-off expenditure. The said marketing expenditure post-inflation one-off after the launch. After the launch means in the first year. That is 1.5 million. $1.5 million. Now less capital allowance for tax saving purposes. Those who have not attended this lecture, second lecture, where I discussed tax adjustments, they should watch that. So capital allowance will be deducted for the tax saving purposes. So here is taxable profits or losses, whatever it is. Sum from here to here. Anyone, any confusion and question so far? Before I proceed, now, the next point is tax rate, tax payment. How much is tax? 25% in the same year. Minus 25% into this. Here you go. 25%. Next. The next point is we have to add back capital allowances because the purpose is done already. Add back capital allowances. Next. Let us proceed further. Initial investment. Minus 1.6 million. Or no, 16 million, sorry. It is, yes. Now, initial investment. Working capital adjustment. Oh my goodness. My goodness. It is 1,025,000. I'm sorry. So let us fix it. Done? Yes. Here you go. It is done. Anything else? Nothing. So we will write net cash flows here. From here to here. Discount factor is 11%. So present value at the rate of 11%. This into 1.11 raised to power minus this. So present values will be calculated like this. And happily, we calculate the project's NPV. Just a minute, please. I think there is some mistake. Okay, the same, they say basically the point is one this which I was actually predicting, that is the number of units. I have sorted out the point. I was thinking about it. Here you see here. 30% year sales volume. Now there is one mistake by me, that they say the same will be the sale in year 3. Now, interpretation. Just read this sentence. And I took a pause at that time, even when I was solving it. This is sales volume is 30% increase in year 3, and then the same in year 4. Okay? So means you can drive two meaning from it. One meaning is that sales will be the same which are here, 206700 here, or with the same rate. Okay? It has two interpretations. You got my point. So I took this 30% increase. Okay? But your examiner has taken it is same sales. Now this what will be the now answer is this error has effect here. And students get worried what will happen with it. If I do same in the exam, it happens in AFM. It happens. Remember, you will not be penalized for this continuing difference. Your maybe examiner say, okay, this person have increased by 30% again here. Assume it. Examiner will see this. And maximum 1 mark will be deducted. Maximum. Why? Because say, okay, there is one mistake here. Okay, so then be same in year phase 4. Be the same. So better is, yes, it be the same means it will not grow. So, right? So it is our mistake. So a continuing error marks will not be deducted. Only at one place it will be deducted. So here is the NPV of the project. So NPV, what is comment? The NPV of project is positive. So the project should be undertaken. Now, my advice to you in exam, since I am teacher, I am teaching you here. So I have to make it perfect. We have enough time here. If I am solving an exam, I will not bother looking back. I will not waste time in looking back, reviewing my answer. What I have done, I will move on. Note down this point. In exam, you will not waste time in fixing and finding error or mistake. Never ever. Move on. The time you will spend here to fix it for 1 mark, you may write for 4-5 marks next. I'm telling you. Now, next point. The next point is investment duration. They say calculate duration of the investment and comment on that. Right. So what we will be doing? We will be second part, duration. Yes. Yes. So year 1, 3, and 4. So present value of cash flows, we have already calculated above. Present value of cash flows is already there. Yes. So weighted average. So total present value. Total present value. Sum. Sum of all present value. So weighted to total present value. This divided by this divided by this. This divided by this. Weighted. Now, yes, multiply with number of year. Number of year. This into duration is equal to sum of all yes, 2.78 years. It is weighted average time. So it shows that majority of cash flows of the project are in its later years of its life, and it will take 2.78 years to recover half of present value of the project. So comment, we have commented on it. Half of the present value of the project, 2.78 years. So duration is also done. It is complete. I'm seeing this answer.